Reviewed for May 15th, 2024. Whenever you get a big gap up, it increases the odds of a trend day. In general, you have about a 20% chance on any given day of there being a trend, but when you get a gap up or a gap down, that's pretty sizable. The odds go up to more like 30%. And, it's a little bit more likely that when you get the big gap up, the trend is going to be a bull trend rather than a bear trend. So big gap up, obviously bullish. The reason being, obviously, is the big gap up can be thought of as just a big bull bar. And if you think of it as just a big bull bar, then obviously it's more likely that it's going to continue sideways, or it's going to continue sideways up rather than it become some sort of trap. Bar one, good follow through for the bulls. So we have a big gap up in a bull bar closing near its high. It's good for the bulls, but I think we need to do a little bit more. We're always in long, but I think bulls need follow through. I thought the important thing on this day, obviously we're a couple days later, but I thought the important thing was at the time this was the all-time high, 22.75. So I thought Wednesday, sorry. I thought this was going to be a really important price today since it was the all-time high. You can see we reached it and we ended up oscillating around it for a lot of the day. But coming into the day, my thought was it was possible that if we started to rally and get some sort of trend, we were going to have to get to that price. Disappointing follow through on bar two, right? So what's the minimum the bulls needed for follow through on bar two? They needed two to be a non-bull bar, or sorry, a non-bear bar. Even a doji bar, like a perfect doji bar, like bar 19, would be still considered follow through for the bulls. But instead, we get a bear doji bar, which is disappointing for the bears. And then when you get that sort of bar, obviously traders are going to scalp out above three, and other traders are going to sell above three because no one wants to buy up there because it's less likely that this is a bull trend. So disappointing. Traders exit. Also, on some lower time frame, somebody bought the high tick of this bar because they were thinking this was a bull trend. And it wasn't an unreasonable argument. So as crazy as it sounds, on some lower time frame, there's a bull bar closing near its high somewhere up here. And the traders who bought that scaled in lower and used bar three to exit. So there's a lot of reasons why there were sellers above two. Bar three, it's a reasonable short for a potential high of the day. If you're doing it, you're basically betting the gap up was a bull trap and you want to sell and get pretty good follow through. However, the thing you have to keep in mind is that we're probably not going to go straight down. We're probably going to go more sideways to down. Just seeing how much those bears made. You get follow through on bar four. Good for the bears. Are we always in short? Maybe, but we probably need a little bit more from the bears. And then you get bar five. Are we always in short on five? I think we're probably always in short, but my problem with selling bar five is the bulls who bought below bar one. So maybe better for bulls to buy below one instead of above one. So after you got disappointing follow through on two, traders instead look to enter on a limit order at the low of one. And the traders who do that are probably going to make money. Why are they probably going to make money? Because this is probably not a bear trend. It's probably a trading range. So it's hard to want to sell down here when you know we're probably going to get back to here. So it makes this a bit difficult. Bar six, a bull bar closing near its high. We do have an open gap with yesterday's high still, and really good looking bull bar. It's an inside bar and it's a high two. So high one, high two, bar six. So it's essentially a big high two on the open. It's a possible low of the day, so it's a credible swing buy. I would say 30% chance that it's the low of the day. There's probably relatively similar odds to being the low of the day as three had to being the high of the day. Follow through for the bulls on bar seven. So we have consecutive bull bars, always in long. But I don't know. After two, three, four, and five, I think that those are four strong enough bars that we might have to go a bit more sideways first and not just straight up. Additionally, right as we became always in short on bar five, the market reversed. So you have to be thinking when you see bar seven, it's possible that as we become always in long here, the market might try to reverse. Disappointing follow through if you bought above seven on eight. You probably wanted to see a better bar, but it is still follow through. And if you look what happened on eight, it rallied up to basically bar one. And any of the bulls who bought above one and they scaled in maybe below one were able to use bar eight to get out of their initial price or their initial short at break even, or their initial buy at break even in their second trade with a long. Nine, probably buyers below eight since eight was a lower high double top for the bears, but a bull bar following consecutive bull bars, so not that good. So I think we're going to be more sideways here. And you can see we did end up getting buyers below on bar nine. So traders, they buy below 9, hoping that we're going to get a second leg up from 6, 7, and 8. 10 triggers the high one above 9. So bar 9 ends up being a high one for the bulls, but it's a bear bar and you're in, probably a trading range. It's still a credible, possible small pullback bull trend. I think at this point, it's pretty safe to assume that either 3 is the high of the day or 6 is the low of the day. And it's more like we're a lot closer to the 3 high. So it's more likely that 6 is the low of the day. So it's probably reasonable to say that 6 is most likely the low of the day. 10, a bull bar. It's follow through for the bulls who bought above the high one of 9, but I don't think that was a great buy. I think it's okay to buy above 10 since we are always in long. But it's just kind of difficult to be long up here or holding. I think it's okay to be holding long. It's hard to establish a long up here. 11, follow through for the bulls, but a big tail on the top. It's a low 2 short for the bears now. So we had a high 2 on the open, and this is now a low 2. But the bull channel up is pretty tight. I don't want to sell below 11. I think we're probably going to go more sideways to up for at least a couple of more bars. 12, you can see there are buyers below 11, the same way there are buyers below 8. So not really a very good sell for the bears. Instead, bulls are just looking at these as pullbacks. And then we get a bull bar closing, somewhat near its high on 13. So what do you notice? There are 2 things you should notice. 1, we have an open gap with the 6 high. So after 4 straight bear bars, a lot of traders will sell above 6, betting that if you do sell above 6, we're probably not going to get, if you do sell above 6, we're probably not going to get a big bull trend. So you'll be able to scale in higher and make money. However, those traders are trapped. After 4 straight bear bars, it wasn't unreasonable to think that we were going to get back to this price. The second thing is we have an open body gap right here between these. It's easier to see on a line chart. Body gaps are just when the bodies of the breakout do not overlap. And you can see here on the line chart, the bodies of the breakouts do not overlap. Why are body gaps important? Because it's a sign of strength. And a lot of traders, especially institutions, use line charts. So when they use line charts, they know that we're probably when they use line charts, they know, or sorry, let me back up. When you use a line chart, you can see that we had the open gap only with the bodies. They don't really care about the tails on bars. They just care about the closes of bars. So that's why it's important if you have open gaps between bodies like we do here. So bar 13, a breakout, and we're trying to reset the market cycle and continue higher. 14, follow through for the bulls, but a big tail on the top. We're still always in long, and this is a really tight channel. So I think pretty solid to be long here by the close, by the market. And we have the 2 open gaps. We technically have 3 open gaps, right? Because we have an open gap with yesterday's low or yesterday's high. So when you factor in yesterday's high, this gap, and this gap, we have 3 open gaps for the bulls, which is pretty strong. 15, a bull bar closing near its high. It's okay to buy up here, but you have to recognize that it's pretty climactic. With this move, the bull trend is getting stronger as it's going, which is good. That's what you want for the bulls. However, you also have to keep in mind that we're pretty high up right now, and we're probably going to get a pullback. I thought we were going to get more of a second leg sideways. I was kind of surprised we routed here. However, 15 does something important. If you look, if you sold above that high, we do not overlap with the 15 low. So the traders, they sold above 3. Let's say they sold 1 tick above, and it probably wasn't reasonable to sell above and try to scalp, make a 1-point scalp. Basically, in order to sell above 3 and not get trapped, you would have had to basically get out around the close of 13. And we have this open gap as well, right here. So if they traders sold the breakout point thinking we were going higher, and instead those traders got trapped. So this open gap and this open gap. So even more trap traders, more chance that we're going to continue higher. If it's a trading range day, those gaps will close and those become profit targets. Like over here, I mentioned, we had this open gap, the 2 high and the 10 low, and traders will sell a bar like 30 because it's, in trading ranges, the probabilities are not quite ever as good as you want them to be. So you want to take a bar with smaller risk. And 30 gives you that smaller risk. So the traders will sell and they'll try to close the gap and they'll make their 5 points. And that's why 31 went down so fast, is because they were trying to close that gap. What was your hint that this was a trading range day? Bar 21. Bar 21 changed the entire complexion of the day. You should not be getting this big of a bear bar if this is going to be a small pullback bull trend all day. So open gaps are important in trading ranges and in trends. It's just you think about them differently. They become profit targets in trading ranges, and in trends, there are reasons to continue to buy in that direction. 16, follow through for the bulls, but a doji bar, not really all that great. I'd rather wait. It's okay to be long, but it's very high up right now. 17, a bear bar closing near its low. You could argue it's some sort of wedge, but I think the bull channel is extremely tight. I'm not looking to sell anything here. The first reversal down is very, very likely going to fail. And then 18, a bull bar closing near its high. Good for the bulls. It's a high one, but you're pretty high up in this trend. There's something to be said for buying it because you are high in a bull trend. And when you're high up, you're in the spike phase of the bull trend is what I meant to say. When you're still in the spike phase of the bull trend, it's okay to take buys that are high ones, even though high ones generally lead to a deeper pullback and then trend resumption. So 18, high one for the bulls. Bears are hoping you're going to get a second leg sideways to down after bar 17, but we'll see. 19, a doji bar, not really great for anyone, but it does something that bar 2 did not. 19 is minimum follow through for the bulls. And a lot of times what traders will do is if they see a bar like 18 and they're not quite sure if they want to buy it because they're worried about getting trapped, they'll just say, okay, if I get any follow through on bar 19, then fine, I'll buy the market. So I'm trying to think of look for another example, but there's certain times where things, have a reasonable chance of being a trap. And I thought 18 was one of those bars where there was a reasonable chance that 19 went outside down. And so a lot of traders will hesitate to buy it and they'll wait and see what 19 looks like. And 19 is not a bear close. So it's technically follow through for the bulls. And since you got the follow through, a lot of traders bought the market and that causes the big rally on 20. Big tail on 20. Okay to be long, but this is getting climactic. Follow through 21. Again, it's still by the close, but you're really, really high up here. At this point, I'm pretty sure we're going to the all-time high. It's only 5 or 6 points above, so very likely that we're getting there. But the question is the path, right? Because do traders want to buy that all-time high? I believe was what was the price? High 22, 22.75. Okay, hold on. Let me put it this way. So 22.75. Good for the bulls, right? But if you're looking at bar 21, do you want to buy the close of bar 21, betting that we're going to rally? You'd have to even get a little bit past the all-time high. So your risk reward isn't really all that good because your risk is really big and your reward's a little bit smaller, and your probability isn't all that great because we've gone up so much. So traders don't really want to buy the close of 21 because they're buying so high and they're betting on a really immediate rally, which probably is not going to happen. 22, follow through for the bulls. Yes, but big tail on the bottom. This is looking like more of a trading range is about to start forming after this climax. How low could we test? Well, we could test all the way down to the bar 20 low, but because that's the bottom of the most recent buy climax. But that's more of a trading range thing. I think traders will be interested to see if we keep the gap open with the 19 high and bar 32 low. 24, which we obviously did. 24, it's a high one for the bulls. It's an outside bar. But I'm not, it's kind of it's an IOI pattern, but I'm not buying above that. I think it's way too high. Probably a better buy below. 25, probably 2 legs sideways to down from 25 and expect some attempt at a, move to the moving average. You can see we essentially had a wedge right here, with 8, 16 and 25. So I think 25, it's theoretically a sell, I think, but I'm not selling against this strong of a bull trend ever. That's just not something that I do. 26, follow through for the Bears, but I think it's mostly just bulls giving up. And disappointment, 27, probably sellers above 26, you can see for a second leg sideways to down. 28, touch the 26 close and continuing sideways. This is just a tight trading range to me at this point. And inside bar 29, I would still remain flat. There are probably buyers below and probably sellers somewhere above. You can see we're forming a triangle. It could be some sort of final flag for the bulls, but we could easily continue to rally. 30, an outside bar, I think that at this point, I would just rather wait. This looks like a triangle, which generally has a 50% chance of the first breakout failing, but the bull trend has been so strong that we're definitely getting a second leg up. And then 31, a bear bar, but a big tail on the bottom. So, we haven't touched the moving average yet all day today, right? So the first time we touch the moving average, we're very likely going to get back to the all-time high, or to the high of the day. And I keep deleting the all-time high. Sorry. 22.75. And then we get 32. And what do you see about 32? Well, it's a smaller bar. You're buying at the moving average, which is good. And you're getting a little better than 2-to-1 risk reward to get to the all-time high. So buying over here with bad risk reward, and you know the market's going to go sideways soon, so your probability isn't as great as you want it to be, especially for the next couple of bars. Instead, traders wait, and then they get the pullback, and they see 32, and they say, well, I can just buy above 32 and put a stop below 32, and it's a higher probability trade. Or sorry, it's a reasonably high probability. It's probably a 50-50 trade. But it's a reasonable probability trade, and I'm getting really good risk reward. So that's why 32 is a much better trade. Follow through on 33, testing the apex of the triangle, which is always a magnet. Again, triangles are just inside bars, and inside bars are final flags. So that's why if inside bars are final flags, is because triangles are final flags. 34, buyers below 33. 33 was a bad low, one short for the bears, so most likely buyers below, which we did find. 35, a bull bar, essentially some sort of outside up, but a big doji. 36, a bull bar closing near its high. So if you don't want to take the buy above 32, which was more of a swing, you can take the buy above 36, bull bar closing near its high. This is a day where, again, you should be swinging your longs and not really scalping them. It's been clearly obvious that it's been a bull trend day all day. So it makes more sense to wait for something really blatantly obvious to exit rather than just trying scalping out and getting back in, because you don't need to do that on trend days. On trading range days, it makes a lot more sense to take quick profits, but on trend days, you probably want to be holding. 37, follow through for the bulls, a bull bar closing near its high. Consecutive bull bars were going higher. 38, found sellers at the new high of the day, but how has that gone for the bears so far today? If you've been fading every single new high, you've been getting killed, and it's probably not going to get much better. As you can see, it didn't really with 39. An inside bar, a high one for the bulls. It's consecutive doji bars, so we might be more sideways. Follow through for the bulls on 40, but a big tail on the top. Excuse me. But still always in long, still okay to be long. What's actually happening in this bar? Why is there so much selling? Well, it's kind of a climactic bar. I kind of want to look at it on a lower time frame and just see. I'm curious. Oh. Yeah, so you can see these are pretty climactic bars. Basically, it's some version of this. You can see 50, 53, 54, 55, 56, 57 was a really climactic move at the end of a trend and probably going to start to go sideways. And this is some sort of lower time frame version of that, it looks like. 41, follow through for the bulls. A lot of good bull bars. We're probably going higher to the all-time high. We're 2 points away from it, so probably buyers getting us there pretty soon. Follow through for the bulls, 42, 43. We're in a pretty tight bull channel, and we're in a micro channel. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We ended up having a 12 bar micro channel, so the first reversal down is going to fail. And but I don't think you want to buy below here, but you don't want to sell it because how strong this bull trend is in the 12 bar micro channel. So in my opinion, I think that even once we got to the all-time high, and you can see we broke above it and then went back below. But that on daily charts, when you touch a magnet on a daily chart, the market usually pulls back, even if it's going to end up going through it. 45, a bull bar closing near its high. We're trying to rally here, but I don't think there's much left to this. I thought this was the target, and we've now reached it. 46, a bear bar closing near its low. Probably okay to exit longs, but this is most likely a minor reversal. 47, follow through for the bears, but probably not great. I think we're going to remain sideways here. At this point, I think most of the edge is gone for both sides, and bulls are going to start to look to buy pullbacks to the moving average because we still have not had a close below the moving average yet today. Outside up 48, but after consecutive bear bars, I think a second leg sideways to down is more likely. Inside bar 49, but am I selling? Nope. I think we're probably just going to remain sideways here. And you see failed breakout above the high of the day, 50, and then a doji bar 51. So we have 3 consecutive doji bars. To me, tight trading range. Wait for the breakout. Probably have a bullish bias because we've been having a lot of bull breakouts. It seems like traders are just waiting to get to the moving average. 52 touches the moving average and found some buyers there. It's a bear bar, but this looks like a tight trading range from 43 to 52, which is a form of a final flag. And whenever you have a final flag, especially like this, the market will usually try to, a bull final flag, the market will try to break above it and then reverse back into it. So you can see 53, a big bull bar closing near its high. We might get the breakout above, but it's probably above a final flag. So I'm not sure how much higher we're going. Follow through 54 for the bulls. 53 was an okay buy. I can't remember if I marked it. Let me see. I didn't. I think 53 was probably fine though. Always in long, bull bar closing near its high. Reasonable to take that. 54, follow through for the bulls. 55, follow through 56. And then 57, extremely climactic. I'm not buying up here. You're getting breakouts above pretty much every single drawable bull channel line. And it's one of the best looking bull bars, really deep in the trend and really deep in this move. So whenever you have that happen, the good looking bar super deep in the trend, it's probably exhaustion. And so I think it makes more sense for traders to not buy it and instead, maybe look to take some profits up here because you're at the top of a channel. 58, a big bear bar, big tail on the bottom. 59, probably buyers below 58, scaling in lower. You know that we might test all the way back down to the 53 low since that's the most recent buy climax low. 60, a doji bar, probably going at least a little bit lower, but you can see 60 traded above 59, so this might just be a second leg sideways down. 61, probably the second leg down and a reversal up 62. The 57 close, while I wouldn't buy it, it is a big bull bar closing near its high after 5 straight bull bars in a bull trend. So some algorithms will buy that with a wide stop and scale in lower. So you know that we're probably going to get back to that 57 close at some point today. 62, a bull bar, but I'm not buying above that. The channel down is relatively tight and the risk is a little bit bigger than I would like it to be. 63, it's an IOI, but I'm not selling 63. You'd be selling on a flat moving average on a bull trend day. So just never a good idea. 64, theoretically follow through for the bears, but it looks like a third leg down in a trading range to me and a reversal up 65. Can you buy above 65? Maybe. I'd still like to see us go a little more sideways first since the channel is relatively tight. 66, a bull bar, but a big tail on the bottom. It's consecutive bull bars though. We might be always in long. I don't think we ever went always in short, but we might be getting back to always in long. 67, an inside bar, and you can see, I think the only other reasonable thing to do, you probably could have bought above 70, but if you're buying above 70, you have to recognize that we've been from 69 or from 60 to 69, we've been in a tight trading range. So buying above 70, you know that even if we rally, the 57 closes the target and it might, be a little bit more sideways to up. And that's exactly what happened on 72. That was the more sideways trying to trap traders out. And then we got the reversal up 73. So for stop orders, I thought 3 was reasonable for a potential high of the day. Some traders might scalp out of a piece of that. 6 is a reasonable buy for a potential low of the day. Follow through 7, you can buy the close of 7. You could probably buy above 10. You can buy breakouts too. So you could, once you have the open gaps, you can buy like the breakout above this high. You can buy the breakout above this high. If you're having trouble getting long on a bull trend day, which is pretty common, the common problem, you can just buy the breakouts, and that's usually a pretty good strategy as well. So 6, 7, good. Probably 13, 15 is reasonable. 16 is maybe reasonable, but it's pretty high up. 18 is fine. Again, 15 and 18, you're probably buying pretty high. So you have to be prepared that we might go sideways. Maybe 21, but that's really hard to do unless you have an ultra wide stop and you're ready to scale in on your premise that this is a bull trend day. If you're buying 21, your premise is a bull trend day. So I don't think there's really any reason to exit. It's kind of the same thing. If you're buying above 6, your premise is maybe it's a bull trend day. But you just have a lot less confidence and you're just kind of hoping that this is the low of the day. So that, your premise is different for those trades. If you're buying above 15, your premise is more second leg sideways to up, but it's kind of tough because you're probably going to go a little bit sideways before you rally. So when you're buying that high in the bull trend, you're probably not going to get a bunch more bull trend bars immediately, but you just have to be aware and ready to, sit through a pullback basically. 32, really good trade. Premise that we're going to the all-time high. 36, 37, by the close, we're probably going higher. 41, good. But I think you're buying, if 41's good, but I don't know if I'd buy like 44. You're just right at the all-time high, and that's where a trader's going to take some profits. I probably wouldn't do anything again until 53, and then you probably get out on 57 more than you buy 57. And yeah, pretty much it. I mean, maybe 70, but I probably would just wait. Limit order trade, probably a good buy below 8 and below 11. And if 9 or 12 close on its low, you just get out. Um, Probably reasonable to scale in, but that's a pretty easy way to manage those because if it's a bull trend day, it's not going to close on its low. On the daily chart, well, I mean, obviously this has happened already, but my thoughts, assuming that we didn't have these two bars, would be this is a very climactic bar and we're probably going to get some sort of pullback. I still think this is an exhaustion gap and we're probably going to close this gap. I'd be pretty surprised if we just rallied and stayed open. So I think this will get a second leg sideways to down. But I thought this was exhaustion and I wasn't sure how much further up we could go. So yeah, on Monday, I think we'll probably go above this day's high. I'm not talking about obviously today, or I'm now talking about the most recent price action. I think we'll probably go above this high, but probably second leg sideways to down. So I'm not sure when we'll close this, but I do think it will be rather relatively soon. Yeah, that's today.